I have the pleasure to welcome our next speaker, who is also at the same time the co-host of this conference. I guess there's no need to introduce Wolfgang Schäuble, so I'll be brief. I'll just tell you a piece of good news. He's willing to take questions after his speech. You have 1.5 hours to prepare yourself for that and ask him all the difficult questions you have on your mind today. Thank you very much. And thank you for coming.
Thank you, President Weidmann, ladies and gentlemen. Can growth be achieved only at the cost of continually rising debt and increasing leverage? This question is at the center of our economic policy discussions in Europe, at the IMF, in the G20. In recent decades, we have experienced an unending cycle of credit booms and busts. Industrialized nations have been pursuing expansionary monetary policies and debt finance fiscal policies since the 70s, with only moderate success in terms of growth. Since 2007, we have seen expansionary monetary policies in most countries dealing with the financial and debt crisis. This has cushioned the immediate impact of the crisis, but thereafter it has failed to stimulate growth, at least in Europe and Japan. But the increased leverage of private and public sectors in many developed countries in conjunction with financial globalization has increased the risk and costs of systemic crisis. The Bank of International Settlements impressively shows the ever-increasing leverage. Over the last 30 years, it grew to more than 3 times the aggregate annual output of advanced countries. If we take a look at the past quarter centuries, there was a credit boom in Japan that burst after 1990. Then there was a credit boom in emerging Asian economies that collapsed in 1997. And after that, we had a credit boom in the advanced economies of the West that went bust starting in 2007. At the beginning of each of these cycles, people said we were entering a new era of prosperity. But each one ended in a crisis that incurred high and long-lasting costs. It's clear that macroeconomic instruments have lost their luster. We saw this already in the 1970s. And then we saw it again most recently when Japan tried, and failed, by the way, to use the tools of monetary and fiscal policy to create growth. What are the reasons for this? Why we have the world's advanced economies seen such much growth since the 1980s? With growth averaging below 3%, when they used to enjoy average growth rates of 3 to 5% before. Even in the decade leading up to the most recent financial crisis, when credit was expanding rapidly and the digital revolution really started to pick up speed, advanced economies saw average annual growth of only 2.7%. Since the financial crisis, growth has fallen to about 1%. Between the early 1990s and 2012, real wages in the United States grew up by 1% per year on average, and in Germany by 0.6% per year. Are we seeing secular stagnation? In other words, low growth in developed countries because saving ratios are higher than investment ratios? If this analysis were correct, many governments and central banks would want to engage in monetary and fiscal stimulus, even if this would eventually lead to new crises. But there is an explanation for the slowdown in global growth, and this is lower productivity for demographic reasons. In the advanced industrialized societies that have traditionally been the main drivers of growth, populations are aging. And population in today's emerging economies will start aging in the near future. It could well be that the demographic megatrend will overcompensate increases in productivity because of the megatrend digitalization. Whether this actually happens or not, what is clear is that high levels of productivity growth are not a given. And this brings me back to the question I asked at the start of this speech. Can we achieve sustainable growth by increasing debt and leverage? My answer to this question is not only no, In my view, expansionary monetary policy and highly leveraged public and private households are not the solution, but the main causes of the financial and debt crisis that have occurred in recent decades. Once again, according to the Bank of International Settlements, Europe's weak growth and susceptibility to crisis have been caused by an excess of household and government debt, over-leveraged banks, and the lack of structural reforms. I fully agree with this analysis. I think the core lesson from the past crisis is that debt and credit-fueled growth driven by over-leveraged public and private sectors does more harm than good. Instead, we need sustainable growth. Sustainable growth defined as steady, environmentally friendly and socially compatible growth propelled by the industrial productivity of the real economy and not by an over-leveraged financial sector. What does that mean for governments, central banks, financial institutions and their regulators? European governments, to start with ourselves, European governments have to make sure that deficits increase more slowly than GDP and tax revenues so that debt levels can be reduced as a percentage of GDP without excessive expenditure cuts. By the way, the talk of euro area countries suffering from austerity is not supported by the facts. The debt to GDP ratio in the euro area is higher than ever before. If we don't, one thing not lack, it's austerity. We have not too much austerity. European governments have also to implement structural reforms. Structural reforms must be aimed at improving the economic conditions, including, most importantly, making an economy more innovative. That's why we have structural reforms. It doesn't just mean having more flexible labor markets or future-proof social security systems. Rather, it means improving education and training. By the way, in this respect, increasing the number of university graduates is not the most important thing. Rather, it's about increasing the number of skilled workers who have been well-trained, both in practice and theory, with a dual system of education and vocational training, one of the relative good assets of Germany. Such workers are enormously important, especially for small and medium-sized enterprises, because they are able to integrate innovations into workflows and to develop their own innovations within workflows. Structural reforms to promote the capacity for innovation also mean just as urgently improving the institutional framework conditions. Efficient and effective administrations that are free of corruption and a judicial system that works quickly make it much easier to found new companies. Where the public sector is excessively large, this hampers growth. Targeted reforms aimed at modernizing and streamlining public administrations can also lead immediately to saving in public budgets. Ultimately, structural reforms to promote the capacity for innovation mean improving the framework conditions for the financing of business ideas, especially high-risk business ideas. We are doing that now with the Capital Markets Union and with the promotion of capital market-based corporate financing in general. We have been doing all this in Europe since the financial crisis, sometimes more successfully, sometimes less so, but basically we are heading in the right direction. And we are seeing the first signs of success. Countries are beginning to reduce their structural deficits. The program countries, Spain, Ireland, Portugal, also Greece, have become more competitive. Unit labor costs are declining. Current account deficits have clearly decreased, partly as a result of rising export. And interestingly, countries such as Ireland and Spain that have pursued ambitious structural consolidation are now amongst the strongest growing economies in the euro area. What is the job for the central banks in this? They are to ensure monetary stability. Also, the monetary transmission mechanism has become unclear, and to ensure financial market stability and break bubbles at an early stage. Also, identifying bubbles has always been difficult. And the job for financial markets, they are to distribute and bear current and future risk, both real and potential, and to provide governments, companies, and private individuals with capital to finance productive investments, neither more nor less. For financial markets to function properly, regulators have to maintain a high level of risk transparency, enforce the strict liability of financial market institutions and actors, and minimize the risk of contagion. Ladies and gentlemen, if governments, central banks, financial institutions, and regulators do their job, growth in advanced industrialized countries will be satisfactory. It may be lower than it was in the past for reasons of demography, but it will be sustained growth without frequent crises. Thank you very much.
Thank you very much, Minister Schäuble, for sharing your thoughts with us. You agreed to answer a couple of questions from the audience. We have until 2:15, so I'm sure there are questions, so please raise. And if I kindly ask you again just to identify yourself when posing a question. So the floor is yours. Who wants to start? Please.
Thank you. Ceyla Pazarbashoğlu, IMF. I'll just repeat the plea which I made last session, which is debt equity bias is a big issue. And I don't know why Germany wouldn't want to lead the way and eliminate the debt equity bias by either allowing for corporate equity allowance or eliminating the debt deductibility of debt. If you could let us know. Thank you.
What don't we allow? I didn't get it.
Right now, it's much, there's the debt equity bias is a big problem. The debt is deductible, whereas equity is not. There's either you can eliminate the tax.
In our taxation system.
In the world,
not in the German national taxation system.
I'm just asking, this is for 25 years at the IMF, we have been asking for eliminating that equity bias, and it always falls into...
Sorry, I got it. Now I got it. But I didn't expect that I have to suffer a discussion in this form on our taxation policy. We used to have this discussion 3 days ago with our Council on Economic Advisors in federal government, therefore, and there's a lot of reasoning for this. The problem in Germany, because politics is always concrete, and it's difficult. Maybe in the United States it's quite easy. You have an elected president who is saying that is going on and everything is working fine. Or you have in France, you have a president directly elected with a granted majority in parliament. He says, so, hey, everything is fine. In Germany, we have a parliamentarian government. You need a majority. German people don't like a majority for one party. That is given on the federal level. Therefore, we have to build coalitions. And normally, we have a coalition between the two main competitors who fight against each other. So one of these both parts, I don't know which one, was in favor of increasing taxes. The other was saying, no tax increase. And they had to build, condemned by the electors, to build a common government. That is the one step. The second step is we have two chambers. The second chamber in Germany is the representation of state governments. State governments have only one common interest, to get money from the federal government. In every other, they disagree. In this regard, they agree, 100%, 16 to 0. State governments are telling us we don't accept any legislation which will, in the result, mean that we will lose €1 revenues for state governments. That is granted. You can. It's not the German members of this audit that can testimony. No no legislation will be adopted, and we need the approval of second chamber in taxation legislation, if the revenues for the states will decrease. In our coalition, we have said, okay, the only thing is what we could agree on taxation was we will not raise tax. We will not cut. That is not to be negotiated, but we will not raise it. But if you have the first chamber, which has decided no change in taxation, which will increase taxation, and you have a second chamber who is saying no decrease of it, the room of maneuver is tending to zero. That is my answer. Theoretically right, practically not to get it. Therefore, I care. We are in the matter of age of retirement. We prefer flexible systems. If you become over 70 years, you can choose how many hours you will work. You work part of times, if you may. I am a part-time worker, and therefore I do only care on things which make sense in realistic. But theoretically, there are a lot of good arguments, of course. Debt financing is preferred compared to equity finance. That's true. But to change it needs a major consensus, and actually we don't get it.
Okay, someone else? Yes, please.
Hello, can you hear me? Yes, I'm Yoshi Kawai from International Association of Insurance Supervisors. And my question to the Minister is your vision of international coordination issue. After crisis, I'm also a member of FSB. We work very hard in coordination under the FSB for next crisis. And if big bank or financial institution failed, we discuss very much cross-border resolution issue. But still, we are living in the nation state. Your country decides your own issue, but other countries is very much closely linked. So in other words, implementation of cross-border, for example, crisis or failure in the big financial institution, current architecture, each state have to report to their parliament and make a decision. Sometimes it's very challenging. So for example, if failure, and they have to share the burden. And my question to the Minister, your vision in the current international architecture like FSB is sufficient for the next crisis in case big financial crisis occur and big financial institution failed, and each nation state could coordinate effectively under this sort of gentleman agreement. If not, do you have any vision that we could resolve next crisis?
Two answers. First answer is FSB is doing very impressive work, and we are very supportive and very thankful for this work. But it's as difficult as you have just described. That's true, because to get global solutions and to get an agreement on behalf of the different interests, it's very difficult. That's why we are starting to build a banking union in the Eurozone. What we are doing, what we did rather fast. In European dimensions, we have been very quick in building a common European regulation on restructuring banks for all 28 member states of European, the Banking Resolution Directive. We have built a common supervisory, a common supervision on the, all systemic relevant banks in the Eurozone by the ECB, not in the ECB, but by the ECB. There's a Chinese wall, which sometimes will be forgotten by the ECB, but I remember every time I can have a chance. There's a Chinese wall between monetary policy and banking supervision. The only institution we could, on behalf of European primary law, use for building a European banking supervision, and this lady sitting just before you is very much in charge of this in the ECB, by the way. We have a bank. I know, no, therefore I do remind you. But you are not in the core of my concerns. You are not in the heart of my. As we know everything. I know. You are by far not a Chinese wall. That would be not very polite. But the Europeans do understand what I mentioned. By the way, I give my best regard to your president. Now, we have a restructuring mechanism with a restructuring board. No, I just have to leave at 2:15 to say goodbye to Madame Koenig, who is leaving our national supervision to move to the European Board for Restructuring. And we have a restructuring fund as well, a European, we are building up. And therefore, and that is my general answer on all these questions, even politically. If you ask me, why are you in favor of more integration in Europe? I am. Personally, I am. My answer is, in times of globalization, and the 21st century is a time of globalization, we need more global or at least international governance. And you may say, oh, Europe is very complicated, slow, bureaucratic, inefficient. Everything is true. But it's by far the best model of new forms of international government I have seen since World War II. And therefore, we are decided to continue our efforts to not only to strengthen Europe, but to show it is possible in times of the 21st century, what we urgently need to find better solutions that only on the level of the nation states will not fit, neither to regulate financial markets, nor to regulate the digitalization of our societies, not only of our economies, but our digitalization. And if you look at political, so we need urgently global solutions. That's what we are working for. But it's a long way to go. But since it is a long way, you have to go every day to work again and again.
Okay, the next one was André Sapir on the left.
Mr. Minister, I'm André Sapir from the University in Brussels. You indicated that the adjustment in the crisis countries within the euro area is taking place, and you give as a proof of that, and I agree with the statement that you made, that the current account situation in those countries has improved and is usually now in positive territory. Now, what we have at the same time is that the euro area as a whole has a current account surplus, and now the euro is depreciating against other currencies. Therefore, one can expect that the current account of the euro area as a whole will further rise. So my question to you is, what is your view about the fact that in a number of euro area countries, including Germany, there is a large current account surplus? Do you think this is a problem, or you think that it's simply linked to the aging of population that you discussed earlier? Thank you.
I think until the last decisions of the ECB, until the fall down of oil prices and the weakening of the exchange rate of the euro, we didn't have, as Eurozone as a whole, a surplus. We had a German surplus. We had a German surplus, but without the German surplus, we would have a deficit, a Eurozone deficit as a whole. Therefore, I never have accepted that the German surplus is a problem for our partners in the Eurozone. By the way, we do what we can. Our growth is driven by internal demand, 80% consumer demand. We have the highest rise of wages we enjoyed since decades. Actually, and I think I'm not the only one in this room who becomes to be nervous that we exaggerate the rise of wages. It may become in 1 year, 2 years critical, but we have the best consumer demand we used to have since ever, maybe. Therefore, what is a little bit we have not in public and even investment in are above the average of the Eurozone, German investment, but public investments are rather fine. We have a lack of investment in private companies, especially in small and medium companies. You can see the numbers. But I think the reason is not they have not enough equity, and they have not enough, they have no credit branch in Germany, by far not. But it's a matter of a lack of innovation and a lack of, and we need too much time to implement, and therefore it's a little bit, and demography as well is one of the reasons. Having said this, I never comment, especially not in a forum like this, any monetary decision by a central bank, because that is forbidden by law and tradition for a German finance minister. Having said this, I have a lot of, no. Don't hope. I have a lot of colleagues in the Eurozone, finance ministers, who have argued for QE. Not me, but some of my colleagues did. And I have said, I will be very ironic. When QE will happen, the immediate reaction will be, the consequence will be, without any doubt, an increase of German surplus. And then you are arguing for QE, but criticize my surplus. I will suffer in 2 weeks in the IMF spring meeting in Washington, seriously. But I tell you from the IMF, be careful, because I will tell you, you crazy girls and boys have asked for QE, and now you must not criticize Germany for surplus. That is not logical. Be careful.
Okay, thanks a lot. I think we should have to stop here. Thanks a lot for your questions. Many thanks for your answers.